Hi there, my name is Jason Ayers, Chief Executive Officer of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thanks for taking the time to watch our Portfolio Manager's Brief for August 2019. Last month, we referenced the continued uptrend in the Canadian and U.S. stock markets for the month of June as being driven by the expectation of a more accommodative monetary policy from central banks, along with a fear of missing out mindset on the part of investors. While the markets rallied into July, they ended up losing momentum as both Canadian and U.S. stocks finished the month where they started. With little movement on the trade front between the U.S. and China, the likelihood of an interest rate reduction priced in, and the end of the month rate announcement by the U.S. central banks looming, there was very little to motivate buyers to push the markets higher. Canadian stocks spent the month chopping about, with notable weakness in both healthcare and energy, while information technology and consumer discretionary were the top performing sectors. The U.S. stock market did a little better than its Canadian counterpart as the second quarter earnings season proved to be more positive than anticipated. However, there was a clear slowdown in momentum in general and, like the Canadian stock market, healthcare and energy acted as a drag, while the information technology sector continued to outperform. We've maintained our defensive stance for several reasons. In analyzing the price charts, we continued to observe technical weakness, suggesting that the uptrend was losing steam and fewer companies were supporting the push higher. And while companies were beating earnings expectations, many were lowering their outlook, suggesting cautiousness, and analysts were revising future earnings expectations to the downside. We have been consistently suggesting that finding good companies at reasonable prices has been a challenge, and the share prices of many companies on our watch list just didn't match up with the underlying fundamentals. In addition, in reviewing our analysis of global economic conditions and the risk of a slowdown, we concluded that nothing had really changed. This further reinforced our defensive stance, continued active management, and discriminating security selection process. Given our expectations that the trade war is likely to carry on into next year, the only real wild card was whether the U.S. Federal Reserve would cut interest rates more than what was factored into the markets. And that brings us to August. With the U.S. lowering rates, but only 25 basis points, more tariffs on Chinese goods from the U.S. and no sign of China backing down, alongside the weaker corporate fundamentals and overbought market conditions, we've finally seen some profit taking resulting in a market pullback. Our income-focused portfolios continue to remain defensive with a higher allocation to bonds and fixed income securities. Certain companies in line with the characteristics appropriate for more conservative investors have been purchased on the pullback as their share prices have become more attractive. Our growth-focused portfolios have also remained defensive and hedged for an anticipated pullback. In line with our overall strategy, we've also taken positions in companies that have been on our watch list as prices have declined and become more attractive. However, we're doing this incrementally as we are not yet convinced that the profit taking is over, and there may be an opportunity to buy more shares at cheaper prices. As we have been reinforcing month over month, our overall positioning remains defensive, and we will continue to be disciplined, active, and selective with what we feel to be market-appropriate hedges in place, and we'll stay the course until our analysis of all the available information suggests otherwise.